Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion, the CEO and founder of Flying V Group, Deep Knowledge Investing's marketing partner. Robb, how was your week?
Week has been pretty wild actually here in Southern California. I was met with all of my East Coast buddies telling me I don't know anything about real weather, yet at the same time we are getting absolutely destroyed because California is not built for even an inch of rain. And so it is raining and it is raining hard, at least relatively for me, but I am surviving and hanging in there.
You know, Robb, by the time I was 7 years old, I grew up in Michigan and I was shoveling snow in the driveway that was like chest high for me. So I have so much sympathy for you. It's terrible that you got rained on.
I
I
said,
don't.
I told them, I said, call me whatever you want. At least I still live in California, and most of the time we've got the great weather. So,
Yeah.
yeah, but it's been interesting. Yeah, a lot of mudslides, flooding, just because again, streets are not built for this. A lot of people without power, but we're hanging in, and it's been fine. We'll be all right.
All right, good. Glad you guys are okay.
Yeah. This week, Gary, so we got the surprise hire for longer issue. We're going to jump into a lot of different topics as we do on this five things. We're talking about Jerome Powell again and the Federal Reserve in doing what they said they do, or maybe the opposite. We'll talk about that. We're getting into manufacturing PMI. Got some more reporting on DKI stock pick Coursera, announced earnings last week. And then we'll talk a little bit of Saudi Arabia oil as well. Ready to go, Gary?
Let's go.
All
What's
right.
first?
Point number one, the Fed shocks the market with consistent behavior. Great headline.
Yes. Yeah, exactly. I was shocked that the market was shocked. So, for the people who are watching this who maybe aren't, buried in finance every day, the Federal Reserve meets, I think it's 10 times a year. And at those meetings, they will make a decision about whether they're going to change the Fed funds rate, which is when you talk about the Fed tightening or loosening, higher rates, lower rates. These are the meetings where those decisions are made. And last week, they concluded their January meeting, and the Federal Reserve sent the market plummeting by announcing that they were not changing rates and they were unlikely to do so at the next meeting, which will be in March. And
Right.
so, the question is, why was everybody shocked? The fact is, these guys have told you in crystal clear language, that they were going to be tighter for longer. The numbers they look at the CPI, the consumer price index, the PPI, the producer price index, the PPE. There are all these indices they look at. And the truth is that inflation, even the way our government manipulates the numbers to make inflation seem lower than it is, lower than what you're experiencing, um, it's still well above their 2% target, which, by the way, is 2% above where that target should be. And, we just saw that, again, manufactured GDP print of 3.3%. People were looking for 2%. We just got, again, faked employment numbers. We've talked about this in recent weeks, but with 9 million jobs outstanding, wages up, and, an unemployment rate of 3.7%, which is still very low. To us at Deep Knowledge Investing, it seemed obvious that the Fed was not about to raise rates. Now, the thing that Powell and the Fed did, which I think really surprised nobody, was they took the tightening language out of the press release. There's been language in the press release for the last couple of years saying that they'll be data driven. They'll look at the data that comes in and figure out what, if any, firming needs to take place, which is their way of saying, hey, we might raise rates again. Now they've taken that language out, and at DKI, we've told our subscribers months ago we've hit the terminal rate, which is the finance way of simply saying it's the highest rate that the Federal Reserve will be at in this particular cycle. Not the highest in your life, but just the highest for now. And the next move is almost certainly going to be a rate reduction. But why the market was shocked when the Federal Reserve said, yeah, we're going to hold where we are for a few months while we still try to get inflation down, and Congress is spending like crazy and manufacturing these numbers. That to me was interesting. I think they've been consistent in their language, with the exception of, some comments that Powell made a couple months ago, which did surprise people because you got very dovish, meaning favoring lower rates at one meeting. But this to us wasn't a surprise, but it sent the market down a couple percent that day.
Yeah, and as you mentioned, election year, Congress not going to be cutting spending in an election year, whereas you said, or in a non-election year as well. So very interesting coming out of the Fed.
Yeah, there's no question on this. And this is, I think, something Rob, you and I have talked about in other video versions of the five things. There is a really interesting policy battle going on right now between the Federal Reserve on one hand, and those guys want to keep rates high-ish. They're not really high, but they want to bring inflation down. On the other side of this fight is the US Congress that is spending like crazy, and the Treasury, which is monetizing things, which is basically creating dollar currency units to pay for all of the spending. And all of that activity is inflationary. And so what we're going to have, particularly in an election year, is no cuts in spending. And so they're going to spend in a way that's going to create more inflation. And so, I think part of what the Fed is trying to do is hold on to the gains they've made against inflation. It has come down, but it's still too high.